Inflation is way down, but people are still worried about that. Hi, I'm Bob Powell, and welcome to Decoding Retirement. Today I'm talking with Charles Chaffin. He's the co-founder of the Financial Psychology Institute and a professor at Iowa State and an expert on behavioral finance. Charles, welcome.
Thank you for having me.
It's a pleasure to have you here, Charles. So inflation is way down. CPI, 2.9%. Personal Consumption Index, 2.5%. Producer Price Index, 2.27%. And we're way down from the 40-year high of 9.1% back in June of 2022. And so on the one hand, people should not be worried about inflation because it's down. But on the other, there's 50% of Americans are worried about it. So what's your take, and what can people do to sort of get over whatever behavioral finance issues there are?
Yeah, I mean, there's an element of recency bias, right? That plays into everything, right? That's why, when we have court proceedings, those final remarks at the end by the attorney tend to stick a little bit more than everything else. So there's a recency bias. People are thinking about it and talking about it, and that impacts their behavior, right? So what can people do about it? Well, I mean, first and foremost is what's your budget, right? What's your planning, when it comes to your daily spending, discretionary spending, discretionary investing and whatnot, and what are your goals related to that? So that's the first and foremost piece. And I think also a lot of people are anchored. They were anchored going into inflation. They were anchored that the price of things were much lower than what they were, which caused a lot of people to go into credit card debt. And now there's kind of that lagging behavior of being anchored at a higher inflation than where we are at. So basically what people could do is within that budget say, okay, what are the things that I need to spend? What are important for me to spend upon? And what are the things that I don't necessarily need to spend, which it could be really, really helpful. I think related to that too, there's an element of loss aversion. Our losses tend to feel worse or rougher than our wins.
Twice as much as gains, right?
Exactly. So we're stinging from that. A lot of consumers are still stinging from that. They're still thinking about that. And so it makes people a little bit more hesitant to spend, whether it's discretionary spending or even within their budget, particularly folks that are retirees. So what basically thinking about, okay, how could we objectively look at our budget, and how could we objectively say, okay, let's get back to what our goals are going to be relative to our monthly expenditures, but also what's discretionary and whatnot.
So it does strike me that some items are still expensive. My son keeps reminding me about how fast food prices are not what they were 2, 3, 4 years ago. And my wife reminds me what eggs and oat milk cost today. So, I mean, some of this is real, right? I mean, it's not as if we're imagining that inflation is high on some items.
Right. It's not just at availability bias. It's not just that we're talking about it so it's on people's mind. It's still out there, and people are still comparing. And quite frankly, to the benefit of that in some regards is that people are a little bit more vigilant right now than they otherwise were, right? They're thinking about prices in a way that maybe they weren't 4 years ago or 5 years ago, which is really, really helpful. But I think all in all right now, if folks can have goals and have a budget, that's going to help them immensely when it comes to deciding where to spend and whatnot.
Right. And obviously creating a budget isn't always easy for people. Are there some behavioral finance issues that come with setting up a budget, and how do they overcome that?
Well, I mean, mental accounting is the best approach, right? So I set up a separate account for whatever my goals might be. So I could have an account for what I would call my monthly expenditures, the things that I really, really need relative to food or medication or my rent or mortgage or whatever it might be. And then I might have a separate account for vacations or something discretionary. And we have lots of data that shows that people that have some name attached to an account that's intrinsic, meaning it has meaning to us or we value it in a certain way, we tend to reach those saving or investing goals much faster. So for example, if I have an education fund and I list it as an education fund, yeah, that's okay. That's a good start. But if I list it as my grandchild's name ahead of it, Emily's education fund, that little behavior can actually help people say, well, I'm giving this to Emily. It has something really specific to it. So mental accounting, thinking about that as tied to the goals as we just talked about, is the best way for individuals to really keep track of what they're doing, having goals and whatnot. It's no different than weight loss. If I have a weight loss goal, I need to be monitoring that. I need to be thinking about that in a very detailed way, whether it's daily or weekly or whatnot. If I stop and I bury my head in the sand, well, then behaviors start to change.
Yeah. So when I think about mental accounting, academicians like yourself sometimes say money is fungible. So these accounts are sort of artificial in a way?
They are artificial. I mean, they really are, right? I mean, it's the same money, but it really is tied to a specific goal. And, with everything we do, we want to monitor our progress. So if we have a goal that an education fund is going to have $10,000 in it within a year or 2 years, I can watch that specific account and I can see how I'm doing relative to the weight loss example that I had where, okay, I want to lose 20 pounds. Let's get on the scale. I see I've lost 3. I need to do more. And that's really, really helpful as opposed to having one account and I'm not even thinking about goals. I'm not thinking about progress, but I've really outlined each of these goals within and tracking those on a daily or weekly basis.
Right. In the old days, we used to use envelopes to stash this money away, right? We would say this is the whatever, the rent money, this is the grocery money, this is the fund money.
It's kind of the same thing as that. It's exactly right, how we separate that, which is really important. And it also reminds us of our goals. We coach advisors almost daily, and we talk about that idea, more goals, more accounts, not to sell a product, but just the idea of it. It helps people be purposeful about everything they're doing relative to their saving and their investing.
Right. So let me go back to inflation for a second.
Yeah.
When I think about inflation, I think there are various tools, investments, products that we can use to manage the risk of inflation, Treasury inflation protected securities among them. What else should people be thinking about?
Well, I go back to, as not being an advisor, and I know advisors talk about tips, and they talk about lots of different ways to mitigate inflation and actually even beat it, which is really, really important. I think for a lot of people, though, depending upon where they are, pre-retirement or post-retirement, are they invested in a diverse portfolio? Are they working with, if they're just starting, are they in an index fund that has really, really low fees to get started? I think those are kind of some basic things they could do on the investing side. And then again, as we talked about earlier, where's their budget? Where are their goals and whatnot? And have they set those things up, whether with an advisor or not?
Yeah. So in one of your books, Charles, I believe it was in Numb, you talked about how people should be ignoring the distractions and focusing on what's important. As you think about inflation, what should they be doing?
Yeah, it kind of goes back to what we were just talking about. If I have a goal in mind for something, I am less apt to be distracted. So, for example, if I'm sitting here talking with you, my goal is for us to have a conversation about inflation and distractions and whatnot. I'm not thinking about anything else. So my behavior is going to align with that. It's when I don't have a goal that I start to have a problem. And in a lot of cases, when it comes to distractions or when it comes to goals-based planning or behaviors or whatnot, if that's new to me or that's difficult for me, I'm not going to think about a bigger goal. I'm going to think about a smaller goal. So if it's my attention, maybe I think about, okay, for 15 minutes, I need to be focused on this task. No distraction, no phone, no television,
no phone?
nothing, right? Maybe for you it's 5 minutes, right? So maybe to start small, right? But if I can, and same way with goals, right? If I'm thinking about, if I'm working with an advisor, I'm not working with an advisor, and I struggle with saving, I need a win. And if it's a small win, that's okay. Let's get started in this. If it's investing in an index fund or whatnot, and I'm putting aside $5 a week, I'm winning. I'm starting something. And then I spread those goals out. We talk about it in psychology. We talk about building self-efficacy. So it's the equivalent of you're at the gym and you're lifting weights and you need a spotter, right, to spot you on the bench. And that spotter's giving you feedback. Come on, you can do this. We're going to do 6 reps. And you're doing that, actually, if you don't have an advisor, you're doing it yourself. You're getting those wins. I did this. I invested those $5 a week. Now I'm going to increase it to 10. I can do this. So whether it's thinking about our attention or thinking about our spending, if it's new and it's something that's really challenging for folks, let's get a win. If we're going to conquer our demons, the way we do it is with small steps first, and then we expand.
Yeah. So I recently had a total knee replacement, and I'm now in a research study where among the things that are happening is I get financial incentives for her hitting certain goals.
Yeah.
And it's not a lot. If I hit 10,000 steps a day, I get $5 a week.
Okay.
Now, right? It's insignificant in the scheme of things, but I've never not got my $5.
Yeah, I mean, that's an extrinsic motivator, which is really, can be helpful. It's a good, you're thinking about that. It's a really good thing to do to get people started. The intrinsic piece is that you want to get better and you want to rehab and whatnot. But when we have those motivations that are both extrinsic and intrinsic, for the love of doing it, for the sake of doing it, plus a little financial incentive, now we've hit the sweet spot and we're way more likely to hit our goals.
So you've mentioned a number of behavioral biases that people have that seemingly get in the way of their decision making. Let's talk a little bit about some of these. You mentioned loss aversion, recency bias, overconfidence. I don't think you mentioned it, but anyway, there's a laundry list of things that people. What are the most significant ones that they need to think about, and what can they do about them?
Yeah, let's talk about the positive first. So, status quo bias is challenging for us because we're basically hardwired to stay where we are. Our brains are hardwired as 100,000 years ago that if we were at a safe spot, we're not moving because we're less likely to be eaten by a lion or whatever it might be. We're inherently lazy, right? So we can use that from a saving and investing perspective to our advantage. We can automate, going back to that $5 a week, we can automate that, right? We can get that taken out of our account. Now I don't have to make 100 different decisions to invest 100 times. I only have to make one, which is, the beauty of living in this digital world. So I could use status quo bias to my advantage. Now, when it comes to something like confirmation bias, which everybody wants to talk about, particularly in an election season, right? We look for news that is confirming our beliefs.
The
and
algorithms
whatnot.
send me that stuff.
The
all the
algorithms
time.
send you. YouTube is great about that. Everybody's great about that. It's like amazing how many people agree with me. Why is that, right? But basically, when it comes to confirmation bias, we're really susceptible, particularly if you think about early stages of cryptocurrency or some elements of active investing. People will post or they'll talk about all their wins. They don't always talk about their losses. The worst clients are the ones that are agreeable, because an agreeable client will, if you're my advisor and you say, well, you should do X, Y, and Z, I'm going to agree with you. And then I go outside here and somebody says, hey, you want to go on vacation for $50,000? I agree with them too. And I just undid everything that we talked about. So if you have somebody like that that's agreeable and they're accessing information that's not useful, guide them, shepherd them towards, okay, not everything out there is, not only is it suspicious in some cases, sometimes it's good information, but it's just not, it's actually not relevant to that particular client, and they don't know that. So help them find sources that are going to work for them and kind of limit some of that confirmation bias.
All right, Charles, we have to take a short break, but when we come back, we're going to talk about how investors can stay the course when the market is tanking. A couple of weeks ago, the market tanked and investors, some, not all, panicked. And with me is Charles Chaffin to talk a little bit about how investors can stay the course when there's extreme market volatility. Where to begin, Charles?
Well, I mean, we have that herd instinct, right? It's one of those biases that, when the herd is running one direction, we tend to want to run with it for safety, right? And more often than not, when it comes to investing, you'll hear advisors say, well, I told them that they need to buy low and sell high. I don't understand why they're not doing it. Well, if we go out on the street here and ask 100 people, where do you buy, where do you sell? And they'll answer it correctly. That's not the problem, right? The problem is that we have this herd instinct. So we know that basically, 7 out of every 10 years, the market's going to go up, right? So for some advisors working with clients or from clients themselves, you know what? You don't need to look at your account every day. In fact, the best advice you could give somebody is don't look at it. It's a long-term investment. Just relax. Don't even think about it. Secondly, for whether it's a client or advisor, you have a plan in place. We'll get to the people that don't have a plan, but let's say you have a plan in place. You have a financial plan, you have an investment plan on your own, whatever it might be. You went through that process of developing that plan that's going to hopefully help you meet your goals. That's all you need to know. Let the storm come through. You have your plan. Stay with it. Don't panic. Just go through that process. Now, if you're developing a plan, you definitely need to be thinking about these different scenarios. You need to be thinking about things like emergency funds, and you need to be obviously having a diverse portfolio and all those different things. But for an advisor to tell a client, and when we had this panic a few weeks ago, it was, we developed a plan, we thought about this, we're fine. We also know from data that when it comes to goals, if I set aside a goal and I say, okay, this is the goal I want to reach, a financial goal, let's say in 3 years, that's a great thing. And I might break that up into pieces, which is helpful too. To go a step further than that, I'll have a 30% chance of achieving my goals if I also say, okay, what are 3 pitfalls that could happen along the way? And what am I going to do about it? Well, inflation's going to be one of those things. Market volatility is certainly going to be one of those things. A life event's probably going to be one of those things. So let's walk through those. What am I going to do if this happens? Or what are we as a family going to do when this happens? And now I'm set. When it comes, there's a 30% more likelihood that I'm going to weather that storm. I'm going to do whatever it is I plan to do, and I'm set. Identifying those hurdles as opposed to say, oh my gosh, the sky is falling. This is not going to work. It's like, no, we planned for this. It's going to be fine.
Yeah. So I'm fond of people who don't have a plan in place to create something called an investment policy statement that outlines your goal, your time horizon, your risk tolerance, et cetera, when you'll sell, when you'll react, when you'll do this. And that's your blueprint, right? And if you stick to that blueprint, you shouldn't panic in cases of what happened in early August.
That's exactly right. It's the same approach to those folks that may not be working with an advisor. You have that plan, and you may even go ahead again and write down these are the things that could happen along the way. And then when you have that desire to panic, because you will have that desire to panic, everyone's telling you that the sky is falling, and you're watching whatever cable news outlet you're watching, and you're getting that twitch. Go to that plan and look at those hurdles. Oh, there it is. Yes, it could happen, and it did happen. I'm fine.
Yeah. So years ago, I worked at a research company called Dalbar, where, among other things, we had created something called the qualitative analysis of investor behavior. And at the time, what we had showed was that the average investor typically underperformed the person who bought and held. And that's because they were, buying at the wrong time,
Right.
selling at the wrong time, reacting to market declines, reacting to market tops, whatever the case may be. And the buy and hold investor who stayed the course outperformed by quite a bit.
Yeah, it's part of it's the that availability bias. So when they're finding out about it, it's likely too late, right? When it comes to the price of what it is that they're buying, right? And then they're holding on to it perhaps too long because they're overvaluing it or undervaluing it or whatnot. But absolutely, it's a huge challenge, and it's that element. It's the equivalent to that friend that you have who has terrible relationship background. They can't be in a relationship, or they can't stay at a job, but yet they give the best advice in the world. Well, why is that? Well, the reason more often than not is because there's an emotional attachment that they have to what they're doing, but they're that objective voice when it comes to giving you the advice. And that's the same thing that comes with an advisor. Or if you're trying to do it on your own, who are you talking with about the decisions? Is it your spouse or partner? Is it a friend of yours or whatnot? But who is it that's that sounding board for you if you're doing it on your own?
Right. So I want to turn my attention to another topic, which I'm fond of talking about, which is this notion of what are the age-related brain changes that go on in older adults. I'm fond of quoting a research study by Michael Finke, who talked about as we age, our financial numeracy declines and our confidence level and our decision making stays the same, but I like to say it rises. So we become increasingly more confident about the bad financial decisions we make. What advice do you have for folks who are older and sort of in that stage of having age-related brain decline?
Yeah, we tend to be more susceptible as we get older to confirmation bias, right? So we make very quick decisions based upon a more often than not on one data point, and then all we do is search for something to confirm that, right? Which is obviously very, 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 very challenging. This element of diminished capacity is something that is people talk about, but there hasn't been a lot of guidance up until a few years ago about, what could advisors do about it. And, there were a lot of, during my time at CFP board, I can remember hearing a lot of horror stories about, clients who had diminished capacity and, this assumption that the next of kin were going to take over the decision making. And in reality, in some cases, they actually weren't looking out for their parents or whoever it might be. I mean, these are terrible stories. And so, having that trusted contact is the first point, right? That's huge. When you're starting that relationship, who's that trusted point of contact? So whether it's your advisor or that sounding board for somebody that's doing it on their own, that they're seeing, they're witnessing memory loss. They're witnessing, erratic decision making or paranoia, or someone who's been, paying their bills on time for 70 years and now they're not. Something's happening there and whatnot. So it is a huge challenge. I think that for individuals who are older that may be thinking about that and worried about that, I would go back to that element of confirmation bias as being the most critical. And it goes back to the information that we have, but also how can you objectively look at some of your decisions, maybe even your past decisions over the past 6 months and say, okay, was there another way around this? Was there another source that I could be using? Should I be talking about I should be talking to my advisor more? The role of the advisor, and this is the work that we do a lot, is really evolving because of AI and because the relevance of the profession to really being that coaching mindset, right? You're really a coach and a partner. And so with that in mind, somebody that may be worried about that and has an advisor, have those conversations. Do we have a trusted point of contact? Should we be thinking about things that we otherwise weren't? Maybe the advisor's been taking the lead from the client. The client's been dogmatic about a certain approach. Maybe it's time to just question those things. Doesn't mean it has to be changed, but just start questioning some decisions to say, maybe we should be thinking about a different approach. And then if things progress to a point where there is diminished capacity, that's where that trusted point of contact is just absolutely critical.
Yeah. Okay. So I know we have a little bit of time left, Charles, and I don't want to get too wonky. We could talk about crystallized and fluid intelligence if we wanted to, but we're not. But I often think of the advice that I've heard from people say, well, you should have your 65-year-old self think more about your 85-year-old self and take the decisions away from your 85-year-old self. Yeah,
there's a lot to that. The crystallized intelligence, basically rises as we get older, and the fluid intelligence goes down. And there's a crossover there. So we are getting wonky. You said we weren't going to get wonky, and we got wonky. But that is true. I mean, that's true. However, I would just say it is true that your 65-year-old self evaluating things but also, though, I think if you take some of these steps that we talked about, whether it's the goals-based approach, where having objective information, questioning the plan that you have and the information you're getting can be most helpful, so that then your 85-year-old self can still be making those good decisions in an evolving world. But if you've got a goal, you got a plan, your 85-year-old self could be just as happy as your 65-year-old self. It's the new 40, right?
It's the new 40. So stick around, Charles. Next, we're going to take some questions from our readers and our listeners in our segment that we call Ask Bob. One came in that says, I have the option of investing in my Roth 401k or my traditional 401k. What do you recommend? And I would say the often quoted advice is look at your tax bracket. If it's high now and low later, you would consider your traditional 401k. If it's low now and high later, you consider using your Roth 401k. Lots of nuance there, lots of things to consider, lots of changes that could occur over your lifetime. Consult with a financial advisor, but that's the general rule of thumb, is to do one or the other depending on your tax bracket. Another question that came in, Charles, is around someone just started working and they have the option of contributing either to their 401k, and how should they invest that money? And what I would suggest to them is invest as much as you can to get the full employer match if you can. So 6% generally will get you 3% from your employer, which is typically the full employer match. And then the second thing is, how should you invest that money? For people who are novices and new to investing, a target date fund is as good as anything to invest in. If you're a little bit more sophisticated, perhaps you could build your own target date fund with the use of ETFs. Maybe you're putting money into a ETF that tracks the S&P 500, maybe 90%, maybe 80%, whatever it might be, depending on your risk tolerance and time horizon and all those factors, and a little bit into a ETF that tracks an aggregate bond fund like the AGG or something like that. Charles, I want to take this opportunity to thank you for joining us and sharing your knowledge and wisdom with me and our listeners. I'm so grateful. If you've got questions about money or about retirement, you can email us at askbob@yahoofinance.com. And stay tuned for future episodes of Decoding Retirement, where we'll have more guests sharing their knowledge and wisdom about how they can help you plan for and live in retirement.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.